We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lior Gantz, founder of the Wealth Research Group. Thanks for joining me today, Lior.
Thanks for having me back.
So why don't we start off by talking a little bit about gold and about how, what affects gold? So why are higher rates no longer damaging for gold?
I think what happened in 2020 is that the market was pricing in all of this free ride and all of the stimulus, the fiscal and the monetary policies, and it priced them to where there was no reason for gold to continue to go up above where it was. So it reached its all-time high. It became apparent that you cannot continue to stimulate the economy in the same fashion, and therefore the risk reward changed altogether. Once that happens, speculators, traders of gold, they can start speculating on how much downside it has. But you can never know. Is it 10%? Is it 15%? Is it 20%? The one thing they do know is that it has more downside than upside. So when the market starts to get to that point where it says, look, the upside here is very limited, the downside here is going to be amazing once Powell just says, hey, we need to start trimming this thing, trimming the stimulus down, or when a vaccine was introduced, because that obviously offered a lot of assurances that we don't need to keep supporting, this income gap that was created because of all the unemployment. And so on that date, on 6th of August, 2020, the market basically collectively reached that point where it was the top. You never know that in advance. You had a lot of reasons to think, because July was the best month for silver since 1980. You had all of the signs that, man, this is reaching euphoric points, and on that date, that's what happened. So you reached that all-time high, and then you started to go to the other side. Bond yields started to go up in anticipation of slowing down, of tapering, of vaccines, of back then of Biden winning the elections and not Trump, and the momentum shifted. When it shifted, it started to shift real hard to where we overstimulated. I think we've over-exaggerated, the central bankers and governments over-exaggerated, and now I think we will have an inflationary problem. And that actually played a negative role on gold for 2021, because if you believe that a tapering is coming and that this is detrimental for gold, and now you think that inflation is a bigger issue than meets the eye, and that it's not transitory, then this is going to be an aggressive tapering, and gold needs to find that spot where the market is priced in the worst type of tapering. That is the bottom. And when that happens, then if the Fed says, look, we're going to raise rates, that's fine, because it's already baked into the current price. You never know these things with any commodity, because it depends on millions of buyers and sellers just reaching that point. What you do know is just likelihoods and probabilities. And we're still, in all likelihood, have not seen the bottom for gold, because you just don't know what the next inflation print will do, or what the next job report will do. If the job report comes in real hot, then the Fed needs to react to that. If inflation comes real hot, then the Fed needs to tweak to that. The best time to know that gold has bottomed finally is when they actually say we're raising rates, because from that point on, there's a lot of assurances on what can happen, right? They're going to probably raise rates to about 1%, right? From 0 to about 1 or 1.25. So if you can start to know the future with that amount of certainty, like I'm going to have about 4 to 5 rate hikes in this cycle, and then that's it. It's over. They're going to start tapering down. Then you can start pricing in what is the price of gold really worth. because if it's only 1% that we have of raising rates, then if inflation remains about 2.5%, 3%, or even more, then we're still in a negative rates environment. And in 12 to 18 months, we're going to have rate cuts again. So then the price of gold reacts to that, to the upside. I think you're in a place where the downside is limited right now, because we're almost at that point where it's almost a sure thing that in June 2022 they're going to start raising rates. But even if they don't, it's going to be July or August. The structure is there, and so I think for a long-term holder, most of the decline is out of the way. And if you don't have exposure to gold, you can start building that position. If you're a trader, I think that you can build up your cash position and wait a little bit more, because I think it will get far more exciting in 2022 once we see that the taper is coming to a close and that the Fed is starting to signal that they're going to raise rates. I think that's when gold will start to explode. So if you're asking me why are higher rates not negative for gold, the reason is that higher rates are already priced in to a large degree. And secondly, that the market doesn't believe the Fed when the Fed says that it is in front of the curve. The market seems to think that the Fed doesn't understand the severity of inflation, and therefore it believes that if inflation numbers keep being hot, that the Fed is going to be surprised. And so there's more of a potentiality of this being more aggressive. Once the market becomes convinced that Jerome Powell says the right words, where the market understands that the Fed is not behind the curve, that it has inflation under control, I think that is also great for gold. It's counterintuitive because people think, well, if inflation is out of control, it's great for gold. Not the case, because that means that you're going to have more rate hikes, and that is not priced in. So I think in general, inflation being under control is good for gold. Raising rates in a moderate way is good for gold. The last 6 rate hikes during this 50-year period of fiat monetary policy, once the Fed says we're raising rates, gold has, on average, rallied by 30%. 1972, 1974, 1979, in the 90s, in 2004, and in 2016, the last time we had a rate hike. So rate hikes are great for gold because the market prices in everything before that.
Interesting. So Lior, when we think about, the real drivers for gold, we always talk about the fundamentals of the monetary policy and fiscal policy. But, switching over to silver a little bit, there's some of that drive silver, but we also hear there's so much of the industrial demand drive for silver. So does the industrial demand side of it start to decouple from gold over the next, let's say 1 to 3 years?
Interesting question. I think we've seen in 2020 that supply chains, bottlenecks, et cetera, have moved up zinc, they've moved up copper, aluminum, they've moved up wheat and corn and oil, many commodities, lumber, obviously. Many of these commodities have gone through some parabolic moves. Silver, not so much. And so when I look at the fact that it is a fairly a quasi-industrial metal, I think it's time to go on a substantial rally as almost inevitable. At some point, you will have, and obviously you saw uranium in the last little bit here. So I think silver, for it to go up substantially, would not surprise me. It wouldn't move as a monetary metal. It will move as an industrial, as a commodity, like you say. But I think that its window to do that is dwindling, because once the Fed really announces that inflation is under control, and once the ports become less clogged, etc., this is going to be playing down on commodity prices. So just keep that in mind. What I think it really does play in favor of silver is the fact that the United States and China are not collaborating. They're literally at war with each other on many fronts. One of those fronts being natural resources. The Chinese are buying and hedging prices for commodities 10 years into the future. They're buying supplies 10 years into the future. Silver is very important to them. And I think that dynamic, the geopolitical dynamic for commodities will be important in the coming decade, because China is moving forward with unbelievable construction projects, many new cities that they're building, new roads, they're building infrastructure and ports and bridges, etc. in Africa, where they're putting in billions of dollars. I think silver is critical to them. And as you know, technology hasn't solved the exploration of gold and silver as it has with like natural gas or oil. The supply for both of these has been dwindling, depleting. We are in a process where we're seeing a decline of about 50% in the capacity of gold between 2018 and 2024. So you are seeing that. Some people call it peak gold, but it's only going to be peak gold if they can't figure it out. But for sure, we're seeing a lot of supply issues with gold. Silver is even more interesting because whereas gold is always above ground in jewelry and other sorts of coins and bars, etc. Silver is, because of its industrial capacities, it is dwindling for real. It's not coming back. Mm-hmm. So it has a demand and supply problem. And as you know, it's so cheap that it's mostly a byproduct. So you have that as well. And that plays into how volatile it can be. I think we've seen that on a monetary side of things, where it's you and I and a few 100,000 bullion traders trying to hoard silver altogether, like we saw in January. I think that doesn't drive up the price of silver on the COMEX. It drives it up in a negative fashion for silver stackers, because they end up going to the dealer. The dealer's out of bullion. If you want to source the bullion, it's a huge premium. So that's not what you want to see, right? You want to see the Wall Street price of silver go up so that you can either sell it high or trade it, and that we haven't seen. And I think for that to happen, the commodity desks at JP and at Goldman and Barclays and all these investment banks need to understand the fundamentals of supply and demand. That's what they're going to care about. They're going to care about silver as a commodity. And when that becomes an issue, like it has with other commodities, they're going to pile into those just as they've done with other ones. We just don't have a timeline on that or any sort of event. But from a risk reward perspective, silver has done something pretty incredible. It trades in a range between 22.5 and 29.5 for over a year, and it just tested that support at 22.5 and did not break. We're $24 an ounce right now as we do this interview, or thereabouts, and so it successfully held support. For a speculator, this is something that they can immediately look into in terms of the risk reward. For me, it gives me confirmation that if silver goes towards the resistance again at 29, and I see that the dollar is weak, going to around 90 on the DXY, there's an incredible trade there with very high reward and very little risk. And the trade is from 29 to 36. If I see that happening, if I see a combination of silver hitting 29 and the dollar going on the DXY to about 90, I will use margin and leverage with options on silver where I see it go to about 36. I might even go on leverage on silver mining stocks. This is going to be something that I look to to do something aggressive with. I think it's a very high reward, very low risk, asymmetric bet.
Yeah, when you say there's, those two factors really playing into each other, like you say, that removes seemingly a lot of the risk there. But you said that when the Fed announces that it has kind of gotten inflation under control, what do you actually expect them to say that heading into, let's say, 2022 here?
So yesterday, that's exactly what Powell said on the Fed meeting. Mm-hmm. He literally again and again said, we have this thing under control. We are ahead of the curve. He was very aggressive. Usually he says things once because he doesn't want to think he doesn't want to project that he's panicked or that he wants to reiterate something because he wants the market to really believe it. He's very calm. He moves the glasses, moves the notes. It's like very academic. Yesterday, he was really trying to convince like a salesman. And that was really interesting to see. So that to me means that they still don't have it under control. What I think, Tom, was really interesting is, let's say, like I'm a dad, right? If my daughter goes on a scooter, falls on her knee, and now she's bloodied up, the whole knee's bloodied up, and I tell her, don't look, everything's fine, just don't look, it's all good. The first thing she will do is panic because she'll say, no, I want to look at it. And I think that's what the Fed did throughout the year. They were like, no, it's transitory. It's transitory. Where everyone understood it's not transitory. So that made the market really nervous about inflation. And a lot of that money went into cryptocurrencies and not to precious metals, because a lot of the people that were not hedged for inflation are the millennials that before this year, they didn't have investment accounts. So they were like going from zero to making a lot of money in the markets in 2020 to now, hey, I need to protect all this money that I just made in inflation hedges. And because I'm a millennial, I'm going to buy Bitcoin or Ethereum or other coins and less precious metals. So I think that is why in 2021, most of the money that flooded into inflation hedges was to cryptocurrencies and not to gold and silver, where boomers are mostly hedged to a level that they're comfortable, because to them the inflation story is already 12 years in the making. People have been worried about hyperinflation since 2008. So I think that's something to think about and consider as well. In terms of like the transitory versus structural. So there were a lot of transitory components to inflation where Jerome Powell was right, where either he was wrong or he just deliberately chose to not discuss it because he thought maybe, hey, if I discuss this openly, the market would react adversely. Obviously, if you have something that's temporary, but it's lingering, it becomes habitual, right? If you say, no, I'm going to start eating cake, just one time a week, but then a year goes by, it now becomes a habit. So the transitory components, which were there, they have trickled now into something that's more structural. And when I mean structural, I mean rents, wages, mostly. These are the very structural things that have happened. The other thing that is interesting is that the job market has completely changed. Whereas before this pandemic, during the Trump era, you got the 3.5% unemployment, and there was very little inflation. Now what happened is all of the stimulus plus the fact that so many people got laid off, right? We got to about 15% unemployment at the height of it. What happened was many people either went back to school to get retrained for a new job, and they're simply out of the labor pool right now. A lot of them, what happened with them is they don't want to go back to those jobs. They're in service jobs with a lot of people, a lot of contact, and they're either afraid of just disruption to their lives because they don't want to go back to self-isolation or quarantine. They maybe have a child, etc. Other people saw their housing portfolio and their stock portfolio go up substantially. So they told their spouse, why don't you just retire earlier? I go for a part-time or something. You have a lot of those people, older people, obviously, like 50 and above. A lot of people went into entrepreneurship. When I mean entrepreneurship, I mean just a small business. It could be anything. So about 600,000 new businesses were opened in the United States in the last year and a half. That's 100% increase in 1 year. So you have a lot of people where the government doesn't know how to count them, right? If you're a dog walker, you're an entrepreneur, but you're a dog walker, or you answer surveys online and you make like $50 a day or something, and now you're self-employed. The government doesn't know how to pick those people up. And then what the government thought is, we'll mandate these vaccines. That will make the workplace seem very safe. And then all these people will rush back to the work. That's not happening as well. So now you're seeing a very tight, extremely tight jobs market at 5% or 5.5% unemployment. And the government just can't figure this out. They're like, why aren't people going back to work? And it's because of all these issues. And so wages are going up because people can quit and get a better job very easily. And so that dynamic is going on. And until employers figure out how to solve it, and the government, maybe the government cancels a few government jobs or projects so that people have to go back to the private sector. We just don't know. They stopped all the stimulus money, but they've now done the child support for the tax credits for about 6 more years, where you get $300 a month for children under 6 and $250 until 18, and then you have subsidized childcare, etc. So you took away one thing, but you gave it away from the back door. And so there's a lot of people that are just living like that. It's not a good life, but it's a reason for them not to go back to work, because they're making enough, obviously, to do what they do. So there's a lot of dynamics here that have changed. And so it's hard for the Fed to say the transitory part is ended. It's extremely hard for them to do that in an economy as big as the United States. Mm-hmm. What I think they're signaling is that the private sectors are figuring out these bottlenecks, and during 2022, we will start seeing more of where this new normal for the inflation is. I think it's way higher than in the past decade. So the past decade, we saw 1.4, 1.5, 1.8 at the peak. I think for this decade, we're looking at 2.3 to 2.8. Now, if you think that's not a big issue, that's a huge issue. That's almost a 50% increase in year-over-year inflation. That compounds really badly. And that's why I think the dollar is in a cycle where it's in a bear market. I think it's a great time for commodities, and especially for precious metals throughout this decade. The Fed is what it can do with the jobs market is very limited, and they've acknowledged that. For them, they've already understood that we are probably at maximum employment right now, as it is. To get more people to come back to the workplace has nothing to do with things they can do. It has to do with incentives, things that the government can do to help employers hire more people. So the Fed is focused solely on price stability, not on maximum employment. And for price stability, they're looking at this at tapering and tightening and whatever they can do there. It's the government that's going to have to figure out how to get more people back into the workplace and not screw the small businesses, because who's suffering mostly from everything that's going on are small businesses. Because if you have rising costs, that affects the small guy way more than the big guy who can offset this with bulk purchases and pre-ordering. Because what does Walmart and Target and all these giants do? They're buying so much merchandise that they got the whole 2022 covered. That's why you got clogged ports and so many truckers that they need to hire, because they're warehousing everything months in advance. And that is another thing that makes it so that inflation in 2022 will probably start to go down for most of these consumer items. Not for rents, not for wages. Those things, in my opinion, they have way more to go, especially because these millennials are making housing decisions and they're making a lot of job-related decisions. Right now, millennials are about 33% of the workforce. By 2030, they're going to be 75% of the workforce. They're a power to be reckoned with in terms of how much they mean to the United States economy in terms of the tax receipts that they're going to be able to provide the government and just the economic impact that they have.
So when we think about the higher inflationary environment that we're heading into, is this why you have said before that we're heading into a dual economy of sorts?
The dual economy concept is basically that there's asset inflation and that the real world inflation, right? Real world is everything you and I just go ahead and touch, right? You go to a restaurant, insurance, the movies, your car, all these liabilities that you have in life, all these expenses mostly. That's where you see a lot of this real world inflation. And then asset inflation is because of all of this money that's just being created and goes towards people and institutions that have access to it. And those institutions are mostly obligated to have low cash levels. But they're investing even though they're not getting the returns that they're obligated to provide or that they're mandated to provide if you're talking about a pension fund, but they have to do it. So I think that plays into housing a lot. Housing, in my opinion, is in a place where it's almost like a bond. Its price is very stable. There's real world demand from millennials, and then there's institutional demand from like the likes of BlackRock and Blackstone. They're buying up so much inventory, and then they're going into commercial and office. It's endless. I think the housing market is something that's going to stay expensive globally. The stock market, very much to the same tune, in my opinion, because you have a lot of demand from retail, exceptional demand from retail, and so much money from the institutional. If I liken this period to some other period, it would be the early 90s. You had 1987, a big fall, right? You had like people thinking this is the end of the bull market. It's a problem. You had the savings and loans in housing. People thought it's the end of housing. And then you had a full decade of innovation and mega purchases. The internet was born, the whole thing. I think that's where we are. We're heading into an environment where there's going to be a lot of innovation and a lot of more upside for equities. The difference is that I think this is going to happen in an environment where inflation is going up and not down like in the 90s. And that's the big difference. I think we're headed into an environment where everything is getting pushed up. And that's what I think is the big difference. Now, where the dual economy comes in is exactly what you're talking about. I think that because wages are going up, because there's less unions involved in wages right now, and they're coming back. A lot of people are unionizing again. The wage part of the inflation is rising, and if people's salaries are going up, they have the wealth effect. They're starting to buy things, and when they start to buy things, obviously the velocity of money picks up. Tom, we're right now at the lowest point for money velocity since they started measuring it. Mm-hmm. If money velocity picks up just a tad, you're in a problem. Literally, you're in a problem. So if we don't have this continued frugal decade where people mostly put their discretionary incomes into assets and create the asset inflation, if they start pushing it towards accessories and luxuries, etc., then I think we're going to have a dual inflationary world.
Mm-hmm. So when we think about this rise in asset prices, Lior, do you think we've seen the blow off top as some have called it?
I think what happened in March 2020 kind of ruined the blow off top. So I think we were headed towards a blow off top, and then obviously a year and a half of this sideways market before equities go up again, as they do, over the long term. And what you saw is such a panic and such a sell that in 16 days you saw the S&P 500 go down by 35%. I think that, to me, is such a great case study for where prices really are for this economy. Because if shutting down the world's economy for 2 months, literally telling 3 billion people stay home, firing millions of people, if that caused a 35% decline, then you have sort of a global support line that you know where it is. Mm-hmm. And I think that is very helpful for an investor to understand. So I think that ruined the potential for an organic blow off top, and just it created it. And in my opinion, we're not at a risk right now of seeing something like a dot-com bubble bursting or a 2008. We're not. I don't see the risk of that happening. It's a very expensive stock market, but everybody knows that it's a very expensive stock market, and everybody is pricing that in. You don't see a lot of froth in the general markets. You see it in other niche markets. You see it in NFTs or in shitcoins or in other sorts of niche industries. But for the baby boomers or the Wall Street money, you don't see euphoria or people being foolish with their decisions. They're very much invested in things that make sense. Now they can be more expensive than before, and that's something that I've already explained why. Mm-hmm. But to buy Amazon shares at 35 or 40 times earnings, that's, to me, that's not a bubble. That is a decision out of necessity. It's not like people are saying, I'm going to buy this now because it's going to triple in 1 year. That's not the environment we're in. People are saying, I'm going to buy that now because Amazon is just an example. Amazon is safer than a government bond, in my opinion. It's growing much faster than most companies. Mm-hmm. And it has all, it's almost like a quasi-company, quasi-bond investment. So I think there's a lot of that going on. A lot of Wall Street money is just flooding into the safest part of the market. And that gives you an idea of how scared they are and not how euphoric they are. I think that what we have is this generation that are 20 to 30 that see, oh my God, with what I'm making right now, it would take me a gazillion years to save up for a house or for this or for that. And so they're trying to take very big bets. And they're in an environment where they say, look, I have this 40-year plan. I'm going to do my degree. I'm going to build a family. I'm going to get into the jobs world, etc. But man, if I can get just lucky once during this decade, that can change my whole thing. So if I can put just $1,000 or $2,000 or $5,000 into something and it grows, 100-fold, then I've changed my entire dynamic for my life. So that's where I think we see that bubble activity more than in the grand economy.
Mm-hmm. So when we look at the 2008 crash versus the crash, say, in March 2020, what were the main differences in behavior in what got sold off as in asset classes? And did that mark a high for the dollar?
The difference is immense. 2008 is, we made it. The investment banks made securitized mortgages, which is not new. They've tried it in the 1800s. It blew up in America as well. They tried it in the 1900s. It blew up. They tried it again with subprime securitization. It blew up. On the flip side, you had homeowners that understood that they're taking a giant leverage in their lives, or were just too naive to understand that they've done that. And it created like a huge problem. And then because that problem was at the bank level, then that created even more problems. And you saw a real you saw basically the end of the system. It was a choice whether or not to give CPR to that patient or just to start over. When it came to those two choices, do we want to restructure the entire global economy, or do we want to patch things up at the expense of the taxpayer? They chose the latter, but the system came to an end. There's no doubt about that. They just restructured it, and off we went. But the price was way more debt than before. 2020 was a healthcare decision that created such a large economic consequence to it, because when you close down the economy and you send tens of millions of people home, now you have, as the government, you have to take that income, that $5 trillion that these people are not going to get collectively worldwide. You have to give it to them. So it was almost like a severance package that was given to everyone that got hurt from the healthcare crisis. It wasn't an economic problem. The economy was doing just fine. It was a healthcare problem that created an economic problem. That is a huge difference, and that's why we came back so easily, because the banks were in a very good position. The economy was in a very good position. Innovation was in a very good position. And so you just saw an acceleration. It's almost like, here's how I explain it. In 2008, the team called the F1 driver and told him, look, you're low on fuel, you have shitty tires, no friction, and your front wing is off. You need to come into the pits. We need to change you. And so you have to go into the pits. It takes 30 seconds. You do the whole thing, and then you come out, fresh tires. You need to warm yourself up a little bit. Takes time. It's a slow recovery. 2020, the car was going like sixth gear. He was having the time of his life. The slicks were doing great. He was turning, and then somebody just put a yellow flag and said, slow down, slow down. Keep them warm, keep them warm, keep them warm. Okay, hit that torque, hit that turbo, and the flag goes up, and then you're off to the races. So it was gave it some more turbo, and the car was fine. The driver was having the time of his life. So I think that's why we're coming back very strong, and we're seeing an inflationary boom right now. So that's the big difference between those two times. And if you got that thing right, then you could have come in my opinion, you could have come in at the bottom or around the bottom in March and started to buy, because you understood the dynamics of what's going on. You understood, and Trump was saying it, like literally, he was saying, we're going to come back real strong. He understood that this is literally, we're just stopping the train, but the train can go back to full throttle immediately. In fact, if you go to our website, to wealthresearchgroup.com, and you either click on the watch list tab at the top, or you go to /watch list, or you go to /price, you can see /price. If you go there, for example, /portfolio. If you go there, you can see my entire portfolio. And now I personally handled the last year and a half in terms of like my own holdings. If you want to see the journey of it, you can go and click that watch list tab and download all the watch lists that we put together. The earliest one was literally in April 2020, when we said this is a huge buying opportunity for stocks. You should get involved immediately. The risk is minimal. This was a panic, a healthcare panic. This is going to be fun. Anyways, look at those two things. I think they have a lot of value, because it tells you exactly what the portfolio is right now. And what I like about it is it gives you also like a limit price suggestions, like where I like to come into these companies personally.
So as we think about, this monetary policy and interest rates, what do you think the chances are that Powell gets in for another term here?
It's a good question. I would like him to, but we shall see. I think in terms of what the Fed has to offer, if it's not him, it's going to be somebody that's way, way more easy on the trigger than Powell is. Powell came from venture capital. He's personally rich. And he's very meticulous. I think that he has a lot of people in his board of governors that would love to take his place. I think he went through a very mentally tough tenure where Trump was giving him a hard time, and then this global healthcare crisis was really challenging him. So I think I wouldn't be surprised if they don't renominate him, because he had such. It's easy to pinpoint mistakes that he's made, but in general, I think that what he did, where if I kind of summarize what he did best, is when he said that the Fed will start buying all of the junk bonds, and never did. Never bought a single junk bond, but that was enough confidence for the markets to go past the panic of the healthcare issue. And I think that was really big for him, because the markets didn't understand that, hey, we have a healthcare issue and we have a great economy. So we don't need to continue, blowing up all these retirement accounts and ruin millions of people's lives. The economy can recover from this. And what he did with the junk bonds, that really turned. That was the day of the bottom when they said that, and they never end up buying even one. It's a stroke of genius in terms of policy. I think that should be remembered for him. Flip that to Bernanke, who was buying hand over fist. I think that what he did not do well, and he could have done better, was the way that he was very fast in terms of the amounts that the Fed was buying in terms of mortgage-backed securities and bonds, not the junk bonds, but treasury bonds. I think they were very accommodative and suppressed interest rates for too long. He should have raised rates more. In 2018, when the markets said no more and tanked like 20% in 1 month, he should have kept going. He allowed the markets to understand that they can dictate to the Fed what the real interest rate should be. And I think that was wrong, because now the whole world, not just Japan or Europe, the whole world is addicted to zero interest rates. And that is something I don't think we can ever escape under this current monetary system. I think that would be remembered as his biggest failure.
Mm-hmm. Excellent, Lior. Do you have anything else you'd like to add before we wrap up here?
No, I'm good.
We touched a lot of stuff here today, and I appreciate your perspective. Of course, you're available at wealthresearchgroup.com. Anywhere else you'd like to point to?
No, I think wealthresearchgroup.com, that's the free financial newsletter on the homepage you can subscribe to. On the top menu, you'll see that tab where I said either special reports or watch lists. These are great PDF downloads that you can just sit over the weekend and kind of go through and enjoy. And if you want to check out my portfolio, that's at wealthresearchgroup.com/portfolio.
Excellent, Lior. Thanks for your time today.
Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.